In this video, I'm going to be forecasting the median house prices 10 years from now for each capital city in Australia. And just to clarify, these forecasts are not crystal ball forecasts. We're going to try to guess what will happen in the future, but rather these forecasts are based on historical price trends. I'll be spending about 10 to 15 minutes to explain the different methods or models that I use to forecast future house prices. And if you don't want to listen to me ramble on for the next 15 minutes, I'm going to start off by showing you my forecasted house prices first. All right, here are the forecasted house prices 10 years from now, with the exception of Darwin for reasons which I'll explain later in the video. As you can see, I have 4 different sets of forecasted house prices, with some of my forecasting models producing higher future prices than others. I'll be explaining later in the video why that is. Pause now if you want to continue looking at these results. Otherwise, let's dive in. We're going to start by looking at the historical national median price for houses over the last 30 years. And I'm specifically looking at the data just for the combined capital cities. Because in this video, we're doing a price forecast for the capital cities in Australia, I don't want to include data from regional markets in this forecast. So for the purposes of this video, I'm going to refer to the combined capital cities median price as the national median price. What we can see here in the green line is the national median house price for the last 30 years. We can see that over the last 30 years, house prices have gone up, down, and sideways, but over the long term, house prices are increasing at a positive rate for most of the time. When we calculate the compound annual growth rate, or CAGR, for the national house price over the last 30 years, we get a CAGR of 7.1%. If you're not familiar with this term, the compound annual growth rate tells you how fast something would have grown in the past if it grew at a steady pace every year. Obviously, house prices don't grow at a steady pace from year to year, but knowing the CAGR for Australian house prices is useful as it gives us a benchmark growth rate that we can use to compare the real estate market in other cities. Interestingly, something that grows at 7.2% every year will double in 10 years. And this is why you'll sometimes hear the saying, house prices double every 10 years. It's because, at least in terms of the national price, the 30-year growth rate has been close to 7.2%. As mentioned earlier, the forecasting methods being used today are going to be based on historical price trends. We're going to do forecasts for each of the capital cities in Australia based on the historical price trends for each city. But before we dive into the city forecasts, I'm just going to spend a few minutes to unpack how the forecasting is going to work using the national price history to demonstrate. First, we want to establish if the historical price growth has been linear, aka growth in a straight line, or exponential, which is growth in a curved line. And when you look at this price chart of Australian national house prices, it does appear to be exponential in some places and linear in others. Fortunately, we don't have to guess here because we have some statistical measures to check if these historical prices have a linear shape or an exponential shape. First, we fit both a linear trend line and an exponential trend line to the historical data, and then we use these statistical measures to determine if the linear trend line is a better fit than the exponential trend line. The results of these measures show that the Australian national house price over the last 30 years has more of a linear growth trend than an exponential growth trend. Personally, I found these results counterintuitive because when you look at the historical national house price data over the last 30 years, and you draw the compound annual growth line of 7.1% on the same chart, this is clearly an exponential growth curve. So why did our previous test show the growth trend was more linear than exponential? The reason for this result is better explained when we break up the last 30 years into 10-year segments, and then measure the compound annual growth rates for each of these 10-year intervals. Here we can see that the first 10 years of the last 30 years, that the CAGR was relatively high at 10.1%. In the second interval, year 10 to year 20, the CAGR is much lower than the previous 10 years at 5.8%. And in the third interval, year 20 to year 30, the CAGR is again slightly lower at 5.6%. To put it another way, we had a relatively high growth rate during the early period of this 30-year history, but then we had a slower growth rate following that early period, and this is why the 30-year compound annual growth rate is 7.1%. But our test earlier did show that the linear trend line was the better fit overall across this 30-year history. I mean, you can see this interval here, that the shape of this line is definitely not an exponential shape, especially up to this period here around 2020. Having said that, the period over the last 5 years is very interesting. When we measure the compound annual growth rate over the last 5 years, the growth rate is actually relatively high at 8.7%. This is higher than the long-term growth rate of 7.1%. From a macro perspective, a lot has happened in the last 5 years. We've had the pandemic, record low interest rates, followed by an increase in interest rates to 13-year highs. We've had record levels of population growth, and we also had record low levels of new home construction. We can also unpack this down to the city level, where we see a similar story. Here, we can see the compound annual growth rates for different intervals for each capital city. We can see that the 30-year CAGR for most capital cities is very close to the national average of 7.1% shown here in the yellow. We can also see that the growth rates do vary between the capital cities over shorter intervals, with the most variation between cities being seen at the shortest interval measured, which is for the last 5 years shown here in the green. Here we can see that half the cities in Australia are recording short-term growth rates at well above the long-term national average, and the other half are growing more slowly. The short explanation for these variances in the short-term growth rate is due to market cycles, with cities not being in sync with each other. But that is a topic outside the scope of this video because today we're doing price forecasts based on trends. So the question is, which trend should be used to forecast future house prices? Should we use a long-term trend like the 30-year trend? Or are the recent events more relevant and should we use a trend based on more recent price history? Should we use a forecast using an exponential trend or a linear trend? Since the question of which method to use is very debatable, in this video I'm going to do both an exponential and linear trend forecast, and you can decide which method has more merit. Let me know in the comments what you think. The projections for each capital city will look something like this. In this slide here, I'm showing the projections applied to the national house price as an example. The gray line here shows the 10-year projection using the exponential or compound growth projection. And here we have the linear projections using the linear price trends for the last 10, 20, and 30 years. All right, without the way, let's dive in starting with Sydney. First, looking at the compound growth projection here in the blue line, you'll notice that it's a little bit different to the previous slide showing the national house prices. This is because this gray line here is Sydney if Sydney had grown over the last 30 years at the national growth rate of 7.1% a year. We saw in a previous chart that most cities in Australia have a 30-year growth rate close to the national average of 7.1%. And this is what it looks like when you compare Sydney's long-term house prices to the national growth rate on the same chart. Also, in our compound growth projection for Sydney, and in order to make a consistent forecast for each capital city using the compound growth method based on the national growth rate, I'm going to make the following assumption. I'm going to assume that the city's median price will converge to the long-term national average in 10 years. The rationale for this assumption is as follows. At any given time, the median price for any of the cities in this forecast will be somewhere relative to this benchmark, but not exactly on this benchmark. In Sydney's case, the median price is above the line, which indicates that Sydney has, at this point in time, in mid-2025, has outpaced the national growth rate of 7.1%. We can also see that historically, after periods where Sydney's growth has outpaced the national rate, the price has converged back to the long-term national average. As you'll see throughout this video, there'll be some cities above, on, and below this line. You'll also see that in most cases, the prices for each of the cities converge the national average over the long term. So to account for the fact that at the time of this forecast in mid-2025, all the different cities will be at different stages in the market cycle and are at different starting points, so to speak, at the time of this forecast. But in order to make a consistent forecast using the compound growth method, I'm going to assume that the median prices for all cities will converge to the price that assumes that prices will continue to grow at the long-term growth rate of 7.1%. Another way to put it is, if Sydney's price converges to this point in 10 years, the measured growth rate over this 40-year period will be 7.1%. Now, whether this assumption has merit is, again, debatable, but I'm applying this assumption to ensure we have a consistent compound forecast for each capital city. All right, let's look at our linear forecasts. We have 3 different linear forecasts using trends from the last 10, 20, and 30-year histories, which gives us linear forecasts using both short and long-term trends. You can quite clearly see that the linear forecast produces a lower forecast price in 10 years compared to the forecast price using the compound or exponential method. Think of the compound growth method producing our most optimistic forecast, and the linear methods producing our most conservative forecasts. By the way, at the end of this video, I'll show you a table with these forecast results for all capital cities. All right, next up is Melbourne, and I'll start running through these slides a bit more quickly now. Here, the compound growth forecast in 10 years for Melbourne is around 1.9 million, while all 3 linear forecasts produce similar prices of around 1.25 million. I find this linear forecast for Melbourne really interesting. For these 3 linear forecasts to be similar, it indicates that the price growth trends for Melbourne over the last 30 years has been fairly consistent and stable. And we don't really see this for the other cities, as you'll soon see, so Melbourne is quite unique in this regard. Looking at Brisbane, the compound growth forecasts a price in 10 years of around 1.9 million, which is quite close to the exponential forecast for Melbourne that we saw previously. For the linear forecast for Brisbane, we can see some big variations. The forecast based on the 10-year linear trend projects a much higher median price in 10 years at over 1.5 million, compared to the linear trends based on the 10 and 20-year histories, which are very similar to each other and project a future price of around 1.25 million. Looking at Perth now, the compound growth forecasts a median price of around 1.9 million, and the linear method projects a range between 1 and 1.15 million. Next is Adelaide, the compound growth forecast a median price of around 1.7 million, and like Brisbane, we can see a big gap in the linear projections, with the 10-year linear trend projection showing close to 1.4 million, while the 20 and 30-year linear trend projections are both similar at around 1.1 million. For Hobart, the compound growth forecast is around 1.6 million, and the linear forecasts have a profile that is very similar to what we've seen in a few other cities, where the 10-year linear trend provides the most optimistic forecast at around 1.2 million, with the 20 and 30-year trend forecast resulting in a more conservative forecast of around 950k. For the ACT, the compound growth forecast is around 2.2 million, and we can see the familiar pattern again in the linear forecast, where the 10-year trend results in the more optimistic forecast at a bit over 1.5 million, and the 20 and 30-year forecast being a bit more conservative at around 1.3 million. And lastly, here's Darwin. Darwin's real estate market has a very different profile compared to the other capital cities. For one, the available market data only starts from the year 2000, not 1995 like the other capital cities, so we don't really have the data for a 30-year trend. Furthermore, the median prices in Darwin have never demonstrated an exponential growth profile over the 25 years of historical data, so applying a compound growth forecast to Darwin is probably unrealistic. The 10 and 20-year linear trend forecasts are quite flat, and that's because the price trend in Darwin for the last 20 years has also been flat. In any case, Darwin's not a typical capital city like the others in Australia. It quite clearly has different supply-demand dynamics, and thus we'll consider Darwin an outlier in this analysis. We'll wrap up this video with some tables to summarize all of the forecast prices and growth rates that we saw in the previous charts. We'll start by looking at the median prices forecasted 10 years from now using the 4 different forecasting methods. This table also shows the median price as of June 2025. So as we saw before, the compound growth method provides the most optimistic or the highest price forecast compared to the other linear methods. And this forecast assumes the market will continue to grow exponentially at the 30-year growth rate of 7.1%. Looking at the other 3 forecasts based on the linear projections, we saw that throughout the video that the forecast based on the linear trend of the last 10 years generally produces a higher forecast price compared to the linear trends of the longer periods of 20 and 30 years. Here shows the total change in median prices after 10 years, and we can see that the compound growth forecast produces a value in 10 years that is basically double the current price. That's because an asset growing at 7.2% a year will double in 10 years, and the 30-year CAGR for the national house price is close enough at 7.1%. So it's high enough to produce a near doubling of house prices if house prices continue to grow at the 30-year rate. This next table shows the total change in median prices as a percentage, but I'm going to move on to the next slide fairly quickly, so pause here if you need more time. The final table shows the projected compound annual growth rates for each of these forecast methods over the next 10 years. You may notice that the values in the compound growth column are not exactly 7.1%, which was the growth rate that I was applying to all cities when using the compound growth forecast. I discussed this topic a little bit earlier in the video, but to summarize, when I made this forecast in mid-2025, not every city had been growing exactly at the national average growth rate of 7.1%. Some cities are currently recording a higher than average growth rate, and some cities are currently growing at a slower growth rate. To unpack this further, I'll give you 2 examples to show you what I mean. Looking at Sydney first. Here you can see Sydney's current median house price is above the line that represents Sydney growing at the national long-term growth rate of 7.1%. If we calculate Sydney's 30-year compound growth rate as of mid-2025, we get 7.4%. But in our forecasting method using the compound growth model, a key assumption made was that in 10 years from now, Sydney's house prices will converge to a price that represents Sydney house prices growing at the national growth rate of 7.1%. So in order to reach this forecast target, Sydney's growth rate for the next 10 years needs to slow down from the current 7.4% over the last 30 years to 6.1% in the next 10 years. Is this assumption reasonable? I think so. When you look at the last 30 years of Sydney's house price history, there are multiple periods when Sydney's house prices were above the line, and in all cases, Sydney's house prices have either plateaued or corrected, and converge back to the price level that represents Sydney's growth as if it is tracking the long-term national average. An example of a city below the line, one of which is Melbourne. Here we can see Melbourne's 30-year compound growth rate as of today is 7.0%, so it's slightly below the long-term national average of 7.1%. So for Melbourne to converge to a price 10 years from now that represents Melbourne growing at the national growth rate of 7.1%, Melbourne's growth rate over the next 10 years needs to speed up to an average annual growth rate of 7.5%. I'll finish off with this chart, which shows the average annual growth rates needed for each capital city to reach a price in 10 years that represents that city having grown at the national long-term growth rate of 7.1%. Because Sydney, Brisbane, and Adelaide are currently recording 30-year CAGRs that are above the national average, those cities will need to slow down a bit to converge to the national growth rate in 10 years. On the other hand, Melbourne, Perth, Hobart, and Canberra are all recording 30-year CAGRs that are less than the national average of 7.1%. And so in order for those cities to reach a price in 10 years reflecting the national growth rate, these cities need to speed up over the next 10 years to the growth rates that you can see here. I've left Darwin on the chart here just out of interest, but I don't think it's likely that Darwin can sustain a relatively high average annual growth rate of 11.1% for the next 10 years in order to converge to the national long-term growth rate. Darwin's track record over the last 20 years does not strongly support the idea that Darwin is a city that has the same growth profile as most other cities in Australia. That said, I'm happy to change my mind if the market data for Darwin starts to perform differently to the last 20 years of its history. I'll finish off here with some food for thought. There was a famous statement from a statistician named George Box who said, "All models are wrong, some are useful." And what I showed today was 4 forecasting models used to forecast capital city median house prices in 10 years. Are these forecasts going to be wrong? Yes, it is very likely they'll be wrong to some degree. Are these models useful? Maybe. These models provided a range of optimistic and conservative price forecasts, and it is possible that the actual prices in 10 years will land somewhere in this range. There was also an economist named Edgar Fielder who said, "If you must forecast, forecast often." And this statement highlights that it is impractical to make a long-range forecast like a 10-year forecast and expect that forecast not to change ever. A lot of things could happen in the next 10 years that could significantly impact the Australian housing market. We could have a major global conflict, another pandemic, a change in the migration policy, the construction industry could find quicker ways to add supply. So who knows what the future holds? Fortunately, with access to the right sources of data, it is possible to closely track what is happening in the housing market from the city level down to the suburb level. And as always, my goal with this channel is to keep you updated on what is happening in the Australian housing market.